Hello and welcome to Exchanges for another week. Very, very excited to introduce our next guest. ASIC has just come out with the biggest roadmap in a long, long time about how Australia can innovate rather than stagnate our markets going forward, where we do things incredibly well, but also where we don't do them so well. So who better than to get on the Commissioner herself? Simone Constant is the ASIC Commissioner. She joins us for Exchanges today, and here is that exchange now. Simone Constant, welcome to Exchanges.
Thank you, Evan. Great to be here.
So you have done an absolute mountain of work over the last year and a bit. Your roadmap is fascinating to read. One of the things that really caught my attention reading into it was what yourself, but also your chair and Joe Longo has pointed out, that Australia must innovate or stagnate. From your vantage point inside ASIC, is this more of a rallying cry or a genuine warning that our markets are risk falling behind the rest of the world?
It's both. It's definitely both. Just in the same way, when we talk about markets, we want both public and private. Here, this is definitely both. It is a rallying cry coming from the place of ASIC. So at ASIC, by law, we're required, and this is great, to strive to promote confident and informed participation in markets and the economy and an efficient and effective financial system. So we care deeply about this stuff, right?
Mhm.
And in Australia, we can be really proud of what we have. We have some world leading investors, for example. We're very proud of the superannuation investments we take globally. We can be really proud that even outside of that superannuation, we're a nation of investors. So, 1 in 2 Australians has investments outside their home and outside their superannuation, which is fantastic. So, there's a lot to be proud of. At the same time, it is a bit of a warning call. And the warning call is that global markets and Australian markets within that, we are at a tipping point. The world is really changing, the world of markets. Your listeners no doubt know that too. And we're seeing some really important dynamics, some shifts, and some of them are global. So, one global is the rise of private markets and actually some flatlining in many public markets, like listed equity markets in particular. And another trend within that that's more domestic is the rise of superannuation and funds under management in Australia. So increasingly, we have those funds that are being put to work, and that also is shaping market dynamics, certainly here in Australia. So at ASIC, we've said it's a really important time first to do what we've done, which is ask some big questions about what do these dynamics mean for the outlook for markets for Australia? What does it mean for an efficient and effective financial system, but also for access and participation, going back to that confident, informed participation. And whether that's people who want to be investors or whether it's people who want growth capital for their business, they want investment, whether they want it through listed equity market or access to credit. For those people, we need to be asking these questions. What are these dynamics going to mean when it comes to markets of integrity, markets with efficiency in the future? So we wrote out to an open discussion paper at the beginning of the year, which is not something regulators usually do. Oftentimes we like to know maybe what the answer is going to be before we ask the question, but we thought, to use your words, it's time for both a rallying cry and a warning call. Let's
Mhm.
ask those questions, and we've spent the year gathering those answers and come forward with them now.
Does that also mean, I'm going to come to the private credit section in a moment, but the other part that comes with what you've set the scene there is, are we missing an opportunity? Are we a little bit at risk of not being ready technically, policy, mindset wise, with where we need to be moving our markets, making sure that not only is obviously your role with the regulation, but the mindset that capital and capital flow is something that we're missing out at the moment?
Yeah, we are definitely at risk of missing out, but we haven't missed out yet. We think at ASIC we've asked the questions in time. We've gotten some really good answers that are the foundation. You can think of, we put out a number of pieces of work this week, but one of them was an overarching report about changing dynamics of markets. And you can think of that as the foundation or the plan, for the firm foundations for the growth on top of it. And we think we've got to the bottom of what's going on in market dynamics and what some of the root causes of maybe problems or flatlining in the public markets are, and maybe if there are going to be concerns for the future in the pretty exponential in some quarters growth in the private markets. We think we've got a bit of a roadmap there too for what we should do to make sure they're markets of integrity and bring those things together. What that means is we think we are now well placed to work with the industry, to work with government, to support markets through our role, certainly, in actually ensuring we seize the opportunity. And whether that's technology, whether it's financial markets infrastructure, whether that's the way we approach listings and, challenging those things that hold back the public listed market as being a place for growth, whether that's mindset. We've raised that question about why is it that companies increasingly think you can't grow on the public boards, that there's not a growth, medium to long term
Hmm.
mindset there. Asking those questions, these are the questions and some of the answers we're coming through with now. We think this work's been done in time. So now it's a matter of take advantage of the opportunities we've got. We're a nation of investors. The superannuation we have, the firm foundations, like the prudentially regulated system that APRA looks after, the regulatory moat that we often hear about that we have here in Australia, the excellent foundations that we have, capitalise on those whilst recognising these changes.
Can I just get you in to go back and just flesh out a little bit that, particularly the public listing side and the flat line that you've described, because it is a concern. We know that, IPOs are declining. They're certainly not at the levels that they were, in the 2000s or even in the tens. And that there is this perception that the capital flow through public markets, in particular in Australia, is not as robust as the US, or it's
Yep.
not as robust as the private sector. I'll come to that in a minute, the private markets. But what did your research find about why we are flatlining in the public space?
Yeah, that brings a great question. It was one of the main questions we set out to ask. So, the best way to break that apart for your listeners is okay, take it in parts. Firstly, we ask the question, are we different to the rest of the world, right?
Uh-huh.
We recognize right up front there's something going on here. Whilst ASX is hitting record highs in recent times, that's market cap. That's not numbers of entities. In fact, in
Yep.
recent years, we've had some years where more companies have left the boards and been taken private than have joined the boards. And that's interesting. When you get behind that as well, you go, what is also interesting is some of those companies that have left the boards, they're pretty big. So think about a Sydney airport, for example. Think about
Yep.
some of those take private transactions. So this isn't about, junior miner stories. Like we've got a great history, for example, of mining stocks. This isn't about smaller enterprises thinking I can get a bit more capital privately for a while longer. This is also about that sort of take private. Why are those companies choosing the private route and succeeding for growth? Why couldn't they pursue that as competitively in the public? So what we asked is Australia different? And we found absolutely not. If you were to talk to somebody who was regulating the London Stock Exchange, for example, you'd hear them say, we're worried about exactly the same thing. Leave aside the US where there is some growth, although, as you would well know, if you take out the Magnificent Seven, and take out the tech boom and the associated, of course, data center boom, the big capex story that we've got, actually, there's some similar challenges there in the US. That's important for us all to acknowledge. This is a global phenomenon. But in Australia, we also looked at what's idiosyncratic here. And something that's idiosyncratic here, of course, superannuation. So APRA regulated super is the size of the ASX, give or take what's going on with market cap and trends of the day. It's like over 150% of GDP. Now, I know that's a stock and flow measure, but it gives you a scale of magnitude for the size of super. So, how is that affecting things? And we've had a lot of discussion lately about are they capped out on Australian equities and therefore they're sending their money to offshore markets, sending their money to private markets, and all of which is appropriate in terms of asset allocation. So, there's a lot of driving factors going on here in the public markets. Question then is, what do we do about it?
Huh.
We wanted to ask, are we a driving factor? Which is not a comfortable question for a regulator to say, like, are the things we're doing, are they making folks prefer to be private rather than public?
Yep.
And we opened ourselves up to that feedback. And to be honest, we're part of the story, but probably a small part of the story. Some things that were a part of the story that are within our gift that we decided to address. We released a streamlined IPO process, so it's quicker to get on the boards. We've said very openly we're looking at prospectus length. Why are they so long? I mean, length of document definitely does not match effective disclosure. Right? You can have half the
Agreed.
size and have effective disclosure. In fact, and we'll talk about private credit soon, that one of the stark things about private credit is some of the longest documentation was not the most effective disclosure. So we've been really open to that. This should not be about paper, it should be about effective disclosure. So we're working on things within our gift. But to come now to your punchline of what do we think the problem is? What is the challenge? One of the challenges, and there are some others, we're looking at, the ASX and how it operates and making sure it's a resilient, modern exchange. The real punchline, though, is there is a sense we got from almost every quarter that it is hard to grow as a public listed company and get patience. And that means all of us in the system have to come together to confront that. That's not just regulation, it's not just listing rules, it's not just investors, it's not just proxies. There is something in that the sort of potential short termism,
Hmm.
and we do need to grapple with it, Evan, because you know what? We really need a healthy public market. It is the mature, well disclosed, got all those great tools that support transparency, market clearing, price discovery, that mean it is the easiest place for access for folks who want growth capital and for folks who want an opportunity to invest directly. Coming back to that point, we're a nation of investors and a nation of businesses who want growth capital.
Yeah, because that fascinates me, and I saw that point in your papers was that it is public listing is a short-termism problem in the fact that they do have, unlike the US, we only have half years, not quarterlies in terms of the actual, relaying of results.
Yep,
That again, shareholders are pretty keen on the public side to make sure that there is return. So dividends are being paid as well as what you're alluding to, and again, they vote with their money if they're not getting the return that they think. And so,
yep,
the ability for a company to use the growth capital in a growth mindset is
yep,
hard,
yep,
which perfectly brings us to private. Okay, because I think that's the next thing to talk about. Is that clearly
yep.
the reason you said they're going to the private market is there is a growth mindset, there is a decade investment process. It probably explains why your papers point out that in the last decade, private credit has grown by 500%.
I know, isn't that a number?
It's a
500,
staggering figure.
that's the domestic number,
Yeah,
500% across a decade. And it's a staggering number. And if you line it up against anything, it's still a staggering number.
yeah,
Growth in public markets, growth of GDP, growth of the sector, financial services sector generally. Whatever you line it up against, it's a staggering number.
yeah. So the question is the growth opportunity that's there, but what are they growing into? Because your paper shows that it is slightly more risky. It is more likely to be property. It is more likely to be debt vehicle markets. Do we have also a slight issue here that, yeah, it's a growth mindset with a decade idea, but it does also have a bit of opaqueness and a risk around it as well?
Yeah. I mean, by nature, private markets are more opaque. Now, we're not saying that's wrong. We keep saying, whenever we can, whenever anyone will listen, private markets, including private credit, when they're done well, they're great for investors and they're great for borrowers or for those wanting capital, right? Whether it's equity or debt. But they need to be done consistently well for that to be the case. And we cannot say at the moment that they are done consistently well. And we'll talk in a moment a bit more about private credit, where we've really honed in and focused. But we accept that private markets will always be that bit less transparent. They don't necessarily need to have the maturity of the public markets. That's the point. Interestingly, though, over this period of growth, you talked about private credit, for example, the last decade, we've seen a lot of liquidity in the world, in
Yep.
Australia and in the world. And some of that is through super and beyond. Some of it's quantitative easing, some of it is actually just intentional by governments. There's been a lot of liquidity. So, one of the things fueling private markets is probably simply cyclical factors that were by design, right? Liquidity in the system, the liquidity premium that you usually get from a public market. It's liquid, liquidity is valuable. Maybe that's been discounted away, right, with that liquidity. So some of this is just market dynamics. There is something structural here, though, right? In terms of the rise of the private markets, there's something structural we see here. And we did ask the question, is it the opaqueness? Is it the fact that regulation is less in private markets? Is that what the feature is? And therefore, is there something that we should be adjusting in our behavior and approach? Now, again, the answer we got was no, this is global. There are market factors such as that liquidity,
Hmm.
and there are growth factors, and there's just more capital that has the maturity, like the super funds or the large fund managers. There are more capital that has the maturity to invest on that private side. And particularly when it's a growth business and they can have some involvement in governance and things. That said, There's some conduct and disclosure concerns, which is at the heart of what we do, and even some market integrity concerns, again, at the heart of what ASIC does, that arise from that growth in private markets. So, an example is, do people who are investing in private markets, do they really know what do disclosures really tell them? Is it effective telling them what they're investing in? Another example, quite different, is a market integrity one. If you have sophisticated investors like a super fund or a large global fund manager, and they've got increasingly large holdings on the private side of transactions that might be worth 25 billion, 20, 25 billion, your air trunks or your Sydney airport. And then you have listed stocks in the same sector. So think of an air trunk and think of a Goodman, or think
Hmm.
of a Sydney airport and think of a listed airport stock or a listed infra stock. Start to have information held on that private side that might be relevant to the valuation, might have an MMPI characteristic to public stocks. So, how do we think about the responsibilities to market integrity, to information in these increasingly sophisticated and broad reaching fund managers? There's questions in that regard. And then there are finally the questions that I really care about. I care about those deeply, but that I care about just as an Australian. What does it mean for access? So,
Yep.
go back to where we started, access and participation. I love that part of our act, right? If investors want to have access, but it is harder to safely get access to the unlisted market, or if people in business wanting capital to grow, it's harder to get access again by definition, especially if this becomes too institutionalized, the private market. What does it mean for access and participation? And that is particularly acute right now when, as a country, we're all focused on how are we going to be more productive? How are we going to get capital to flow to places where we want to see things grow? And so that access and participation question means it's incumbent on ASIC to do our bit to ensure conduct and disclosure and the rules and regulation and the way we go about things are match fit so we can maximize that access and participation if this is where the growth's going to be.
Massive answer. Fantastic. So I then need to dive into a couple of things out of that. So you talked about that opaqueness and the valuation. So using public listed valuations versus those
Yeah.
private listed valuations. That's a fascinating concept because that brings me to under at the moment, untested stress scenarios inside private markets is a big
Hmm.
thing. So
Yep.
we also know that you've talked about super as well, part of it. They've had to revalue, particularly their property assets,
Yep.
up and down on, the valuation being hard to reach. But the other part of it is if we are about to go through what looks like from the RBA this week, we're doing this in the first week of November, that they are out of the rate cutting market, that they could actually be now engaging in a possible hike market. That stress that goes through the private market, the valuations that are there, how quickly can this spread through the system? And the other thing about private credit is the liquidity, as you alluded to, unlike a publicly listed market, in
Yep.
and out is not as easy. So where does ASIC sit with all that at the moment?
Yeah, where we sit is really interesting, really interested. Alert, but not
Mhm.
alarmed. Raising an alert about the fact that we'd like to be more informed and looking across the whole system alongside our other regulators. So, how do you unpack that? One of the most interesting things about this work we've done is this system impact. Now, at ASIC, we actually always start from that consumer, investor, borrower perspective, like it's part of our mandate and it's wonderful. But we do work back up to our role as part of the Council of Financial Regulators and working alongside APRA and the RBA and Treasury and others, thinking about the system impact here. And something that we've said, and we've said it in our report, is that we don't have enough information about the private markets for the size that they're becoming.
Uh-huh.
Now, that's information at the investment level, and we've talked about we want to see wholesale funds being registered and audited, so there's information. So when things go wrong at a particular asset level or entity level or investment level, got the information, we know what's going on. But that also rolls up to some work we've done about data and transparency, which shows that in Australia, our public markets information, it's strong, mature. Our private markets information, we're actually subpar in terms of what we receive as a community of regulators and the transparency we can then give back to the market. Because, of course, a lot of our information can then be made available so we can open up access. Being informed allows participation. But we're below some peer economies and peer regulators, Singapore, Canada, the UK, even the US, right? We're below that level of disclosure, which means the chair of ASIC sometimes says flying blind. Now, I'm not going to be as strong. A chair can say flying blind. That's a pretty strong statement. I would say we want to be more informed. Why does it matter right now? Or it always matters, but as you say, we're at a point of potential change. As rates go up, for example, when you think about that, private credit, but even private equity, which, as we know, has a real reliance on leverage, this is when we might see a point of stress. And something I've said a lot publicly lately is we're not saying that this is alarming and that there's going to be a crisis and this is going to generate a crisis, but we are saying that whilst no crisis ever repeats the same, we do learn from prior crises.
Yep.
And you need to therefore observe what looks different this time. Where might there be risks that we don't understand and that we're not going to be able to mitigate and manage in an informed way? And what looks different this time if we were to have a crisis, or as you say, for example, we get a quick hike in rates because we see real change in economic conditions, for example, it is the rise of the private markets. So you think about it, since the GFC, which was the last mega stress, I think COVID's quite different because of the nature of what it was and the way we
Yep.
could all work together. But the last financial crisis, that private side is where the real growth is. And I would say, in some ways, the private credit, a lot of folks have talked about private credit lately and Tricolor and First Brands. And you would say the Australian private credit market is different to the US, and we'll talk about that in a moment. The Tricolor and First Brands, for example, were specific failings
Hmm.
associated with specific types of credit into a specific class of asset. And we don't have as much of that type of lending here. So, vehicle financing, receivables financing. It's a broader church in America. But what I would say that does worry me is it's actually never about the specific failing here or specific failing there at the actual front end. In a crisis, it's always about what's going on at the back end.
Yeah.
So, where is that interlinked through financial engineering and leverage into the system? And you get that correlation. And now we need to think about, and where might that sort of private credit exposure interlink at that back end through engineering with private equity that we also don't know about, with NBFIs, non bank financial intermediaries, and then with the banking sector, when we're seeing so much splicing and cutting and bringing together. I mean, interconnection's wonderful, right? Markets are wonderful the way they continue to bring capital flows together. But we don't know enough about what's at that back end in Australia. And I think RBA would agree with me and APRA would agree with me.
Yeah, so I'm going to bring back to your chair because I know you can't say it, but he did, which is he warned of a potential Minsky moment, which is obviously a collapse born
Yeah.
out of complacency, and you've just sort of somewhat alluded to it. Therefore, how close could we be to that kind of scenario? Because you are talking there for about that financial engineering, that level of complacency because of the opaqueness that we're just sort of okay with what's going on. Is that where we need to be a little bit more open to the idea that we do need to have a bit of a look under the hood in these spaces and therefore we can mitigate a Minsky situation?
That is spot on. I couldn't have said it better. I would say
I
I've
was
been
trying to ask
asked
that as
that.
a question.
Yeah, I've been asked that. Oh, are we at our Minsky moment? And I've gone to great lengths to say no. That's the chair did not say we're at a Minsky moment. He said we don't want a Minsky moment.
Yeah.
That's why we've asked the questions, and that's why we brought forth the challenge and the ideas, and that's why we're asking for the data and information. But you're absolutely right. Like, we cannot be complacent. So we need to know where these links are, where this stress in the system might be. And then at an individual entity and investment level, we need to make sure that the guardrails and practices are robust so that you don't get that ripple back from bad investments and bad outcomes and a level of complacency, whether it's in private equity, private credit, or they're linked back into the banking sector.
I also then want to sort of splice back into, using your term, private into public. One of the things that has been raised on this podcast before that has been a bit of a concern is big firms or even just developing growth firms not having the off ramp, right? Not having the
Hmm.
ability to actually to get off. Part of the reason why they look to the US, for example, some of their argument is that they do have different class structure in their sharing, so A and B structure. Meta's a great example. We know that Atlassian,
Hmm.
an Australian player, is that also part of the roadmap to the future is looking at maybe different structures, allowing private credit to go public, staying in Australia, but also allows founders to structure their business in a way that is beneficial to them to off ramp, uh, you know, an enterprise that they've created from their back room or wherever it happens to be
Mhm, mhm.
into a behemoth like a unicorn.
Yeah, on the equity side, we've definitely signaled we're open to more ideas. And the chair spoke at the National Press Club, so you can't get more public American than that, about we're asking the question why a smaller biotech stock, for example, that might have been founder established and has hit upon some fantastic ideas and needs growth capital, why a listed small biotech entity might have that much more regulation and requirement than, I used the example of Sydney Airport before, but that's a great example. Really large entity, really big responsibilities, and even adjacency to everything from national security to freight. And so I think we think there's some really good questions there. And we've been asking, where's the nub of that? What are the one or two things that might make a real difference in the way we go about what we do? I'd say private credit's different. Private credit's different to the equity, that so a lot of the
Yep.
private markets concepts are very similar, including in what is good practice when you're making these investments and setting them up and being a fund manager. Private credit, that our questions about private credit at the moment, and we'll probably get into those in a moment, they're more actually at the if you've got a sector that's growing 500%, it's perhaps less about converting it into off ramps in a public space or splicing it into the financial system. We think at the moment it's more about calling out some of the poorer practice
Yep.
so that we can be informed at the system end at knowing how much we've got and where we've got it. Because even the 200 billion plus number that we give for the Australian private credit number that our experts gave us, we're not sure that's right. It may be, significantly more than that. So whether it's being more informed there, and at the same time we're calling for better practices at the front end, at the specific fund manager level and the raising of that capital. So it's different concerns in the credit space, different concerns emerging to what we've seen in the equity space.
So if you don't mind, I'm going to sort of ask you about two that have happened in Australia recently, Latrobe
Mhm,
Financial and True
mhm,
Pillar.
mhm,
They obviously are offering above inflation rates and above bank rates for
mhm.
creditors, and then obviously the debt rate is much, much higher. What in their products was it a one-off, or is there more systematic issues inside those kinds of names? Not, I mean, I'm not singling them out in any shape or form, but their concerns obviously got you to step in, but also it's what you're alluding to as the concern around private credit, is it not?
So I'm glad you letting me step away from those specific
Yeah.
entities because they've made their responses.
Uh,
And actually, I should say, by the way, many in the private credit industry both started this process with good practices, and we've tried to shine a light on those. And also, many have welcomed our work. So there's been a real maturing of the industry, in our opinion, across the year, and that's really good to see. And there's some industry leaders, both industry groups, but also some of the larger and smaller participants who've been really strong voices in that and worked with us in that regard. But in case this came up, I hope you don't mind. I hope you don't mind. I've got all my
Go
documents
for it.
here. You
Yeah.
can't, you got to forgive me, right? We do all
Let
this work. I'm gonna have it here.
you
So
dive into it.
one of my favorite pages in the hundreds of pages we've put out is page 4 of our private credit surveillance. And if you ask me what we're concerned about, I think the best summary is there. I'm just going to read you a couple that, like, actually, all jokes aside, and mirth aside, and pride of the work aside, some pretty concerning things.
Yep.
So, firstly, inconsistent and unclear reporting in terms, masking portfolio risks and challenging investor decisions. So, we looked at 28 funds. Now, remember, there were some better practices and poorer, but if it's made it onto page 4, we've seen a bit of it.
Yep.
What does that mean? It means that whilst the levels of default reported range from around 0 to 6% of the book, our big concern is that there's such inconsistency in what default means. So if you think about effective disclosure, my goodness, this is credit. That's where it starts. One fund that we state, you've got default when there's non-payment. There's sort of 90 days past due. Another fund, though, it almost needed to be an enforcement before default was called. Now, that is real variability. And if you think about how important that term is
That's a
when you're
huge
understanding,
variability.
yeah. So, and I'm just reading facts, right, as reported. I'm not passing judgment or naming entities, but Another one, opaque interest margins and fee structures obscuring the risk and cost to investors. And I think that's where you were going.
Yep.
Only 4 of the 28 funds published information about the interest rates or ranges charged to borrowers. And another one, only one wholesale fund, so we looked at 8 of them, only one passed on the full economic benefits of interest earned from its assets and other fees. In a contrasting example to that one, another wholesale manager took a substantial interest margin of 7.5%. Yep. Weak governance and poorly managed conflicts of interest, risking harm to investors and confidence. So, less than half of the funds had detailed written credit or impairment policies in place, prompting concerns credit risk is not properly managed in a credit fund. And only half of the wholesale funds had a policy governing fair allocation of investment opportunities if they had multiple vehicles. So, if they had co investment vehicles. And then the final 2, poor valuation practices impacting entry and exit prices, performance, and fees. Most funds we reviewed did not have effective separation between the investment committee approving loans and the representatives responsible for monitoring them and indeed for valuing them with third party valuers after they were put into the funds. And finally, of the wholesale funds, so you've asked a bit about liquidity. Of the wholesale funds, and only 2 performed stress testing, which of course is critical for preparedness for a stress
Yep.
scenario. Only 2 performed stress testing as part of their liquidity risk management. So, I'll go back to what I opened with. There are many with good practices in the private credit space, and actually the industry's been incredibly mature. And even in our report, we highlight some really better practices. Think about the one fund, for example, who passed on economic benefit in full. That said, there's some really concerning practices that we saw in our surveillance. And we would say, and I said this publicly this week, this is not the end. We're about to start our next private credit surveillance where we're going to hone a little bit in on where there's concentration in property, because that is a defining feature of Australian private credit. About 60% is property, and probably we'll be looking at when there are continuation funds, for example, where we saw some interesting practices, and there will be more. Like if we see enforcement action is required, we will be taking enforcement action.
I can't believe I've already run out of time. I didn't even get to talk to you about things like superannuation. It's been an absolute pleasure. So, as I always finish all of my exchanges, Simone Constant, if you're in charge for just one day, what would you do?
Well, it's hard. I'm a working mum, so you got to divide yourself in 2. So part of me says I would create 2 of me so I could do things better for my family as well, doing this job that I love, that as you can tell, I'm pretty passionate about.
Yes, I
But
can.
actually, do you know what I'd do? I would actually, if I was in charge, I would get all of us who are involved in financial institutions in the system. And I've been an equity investor, I've been a CRO for the insto side of banks and treasuries, I've been in a treasury. I'd been a fund manager. I would get all of us with big roles in the institutional space, get us to take our vested interest hat off and like listen and trust and think, how are we going to focus on that access and participation? And not just so there's access for folks to continue to invest and we have a healthy system, but so that if you're a smaller entity wanting funding in a world that's getting more institutionalized in Australia, so there'll always be access to capital for growth and we can kind of confront that productivity challenge. So that'd be my answer.
That's a beautiful answer. Simone,
Wishful thinking.
yeah, that idealism should actually be something
It's
that
at
we
the
could do
heart of
reality,
this.
right? But that's the reality that we are trying to reach here, and I think that's a
Totally.
beautiful, beautiful answer. Simone Constant, it's been an absolute pleasure to have you on Exchanges.
Nice to talk with you, Evan, and I'll talk to you soon.
Big thank you to Simone Constant. What a talk, and her passion shows very clearly that ASIC see themselves as a partner, not a straight regulator, in making sure that Australia's prosperity and capital flows continue to make us prosper. I think that's the biggest distinction that you need to take out of this, is that is what ASIC is there to do, is to allow capital to flow to where it needs to go. So again, thank you to Simone Constant for giving us an incredible insight into where ASIC is going. To you out there, as always, thank you for so much for listening, watching, or wherever it is you're getting this. But don't forget, if you can, please subscribe, and if you can, give us a review. We do have an email if you've got any ideas or guests that you think I should get on. It's exchanges@evanlucas.com.au. But until next week, thank you as always for listening. We'll speak to you then.